Welcome to Capital Decanted. In this show, we say goodbye to tired market takes and superficial sound bites. Because here, instead of skimming the surface, we dive into the heart of capital allocation, striking the perfect balance and exposing the subtleties that reveal the topic's true essence. Prepare to have your perspectives challenged as we open up the issues that resonate with the hearts and minds of those shaping capital allocation. We've enlisted the wisdom of visionary leaders in the industry, and just like a meticulously crafted wine, we'll allow their insights to breathe, unfurling their hidden depths and transforming our understanding. This is Season 1, Episode 14 of Capital Decanted, Secondaries. I'm John Bowman.
And I'm Christy Townsend.
And we are your hosts. As always, a huge thank you to our Season 1 title sponsor, Franklin Templeton Alternatives. With over 40 years of alt investing and $260 billion of assets under management, they've assembled and offer specialist investment managers across 6 different asset classes: private debt, hedge funds, real estate, infrastructure, private equity, and venture capital. And of course, all of them operate with the client-first mentality that has always defined Franklin Templeton to prioritize investment outcomes. Now, we'll be chatting with one of those managers today. In fact, K2 Advisors, their hedge fund offering at halftime. So stay tuned. And thanks to Franklin Templeton Alternatives. Well, Christy, this is the last round, our last hurrah, the Season 1 finale. Listen, listeners, we couldn't be more thankful for our inaugural season of Capital Decanted. We, I think it's fair to say, exceeded even our most optimistic expectations. We've been so fulfilled in the now, as I've said, 14-episode ride that we've taken together. You talk about a standing start. We were voracious consumers, as many of you probably are, of you might call the podcast medium, but certainly had no experience launching, executing a show ourselves. But we've just simply been blown away by the take-ups, by the downloads. We, by the way, hit 10,000 listens this past week. But more importantly, I think what's been more heartening than even the numbers has been all of those informal encouragements and affirmations on the road, those random great jobs, or I listened to that one, or I enjoyed this episode regarding the show. That's just been the best. A funny little anecdote, I'm not even sure I've told you this, Christy, that encapsulates this. So it was a couple of weeks ago, I was at church and a young couple that I kind of know was sitting next to us, and they had friends visiting, I guess, from out of town. So after the service, as I normally do, I introduced myself, much to my children's chagrin, embarrassed them all, introduced myself to strangers. And the husband mentioned that he worked at Nuveen Natural Capital. So of course I said, oh, that's funny. We did a special episode on our pod on the history of wine investing with your head of viticulture. And he literally looks at me and says, wait, that's you? You're Capital Decanted? So needless to say, I gave him a big hug. That was the coolest thing ever. And that, by the way, listeners, is episode 5, our wine investing episode. But that was just a blast and really made my day, to say the least.
That's so awesome.
Yeah, I know it was good. So before we tackle secondaries, a few quick programming notes for those of you listening, given this is the last episode. We're going to take a few months off this summer. And I should say precisely summer for us Northern Hemisphere folks, those of you down under, below the equator, it'll be your winter. But that's going to be an opportunity for us to reset, to bring a new Townsend into this world, but also to reflect and consider tweaks, of course, and improvements ahead of Season 2, which we've just started to think through. We've already got a couple amazing episodes, by the way, booked for Season 2. We're excited to share that with you eventually. And we'll be building out those themes and the other guests in the coming weeks. And we're working on a more comprehensive and creative sponsorship model, I should say, as well, because we've really, and this is so fulfilling, had many incoming inquiries about support in the recent months. But here's the thing, and I can't stress this enough. We want your help, listeners. Please do email or LinkedIn message me with ideas for topics or themes that you'd like us to consider covering, or any other general advice or counsel on the show format itself. We really are open ears. We want this to be for you. We've enjoyed it. We felt like we've taken this ride together, and we want to continue to make it better. So now that we have this loyal listening base, you need to help us architect that next season. So last thing to note here is that we're going to re-release the top 5 episodes of the season over the next several weeks just for fun. So keep a watch out in your feed for those reoccurring top episodes. And by the way, I should say the horse race at the top keeps moving week to week. Our production team gives us weekly updates. So we don't even know who's going to be the top 5 at this point. So we'll be as surprised as you will when we see that. So Christy, we're going to spend some time in the last sip reminiscing a bit more on our first season. But anything to add here as we head to our season break after this particular episode?
Just I share just your sentiments of how it's been a lot of fun. And I want to thank our listeners and our guests and our production team in the background. Susie, Paulina, you guys are amazing. Because of you, our inaugural season was great. And I cannot reiterate that enough. And then beyond that, it's been fun. It's been a lot of prep work for each of the episodes. John, I know you and I have talked about it. It takes many hours to get each of these episodes off the ground. But in the process, I've just learned so much in terms of not just market knowledge, in terms of getting to know guests better, in terms of even stretching my views on how to be a better investor. So I think overall, I'm just really thankful and excited for our second season. And hopefully I'll be much less out of breath after, as you also alluded to, this baby gets here. So for those of you listening, I'm a little over 9 months pregnant at this point. So I have anywhere between 3 and 4 weeks left. And it is June in Texas. So I think I'm ready for him to get out. So all of those things have me looking forward to our second season, but also excited to wrap up this first one. It's been a great run.
Yeah, Texas heat. Having gone through this many times, at least as a supporting husband, Texas heat and 8 months pregnant are not a good combination.
It is not a good combination. It is very rough. So yeah, like anytime y'all have heard me wheezing on this podcast over the past couple of months, it's just lack of space for my lungs and things getting increasingly hotter here.
Well, we're excited about that. As I said, we structured the break. Coincidentally, it is perfectly aligned with the due date. So there you go. So all well said, Christy, and I echo all of that. So secondaries. During my prep, I had this strange and humorous metaphor as I progressed through the reading, the writing, the reflecting. So this metaphor came to mind for me. So I want you all to imagine with me back to high school. And by the way, some of us, that's many decades. I won't say who, but many decades. But I assure you that all of us had at least that one crazy, cringeworthy, painful to be around classmate back then. You picturing him or her now? So get them in your mind. Now, here's the thing. Inevitably, recently, in recent years, you've randomly checked LinkedIn on what they're doing. And often they're like CEO of a company. And you're thinking to yourself, how did this happen? This was a guy or gal, I suppose, that you turned the other way to avoid unhinged conversation at parties. They were the type that you didn't want to be near proximity to them when the cops showed up because you were going to be an accessory to a crime, no doubt. But somehow, some way, you look on LinkedIn and they've cleaned up, they've rebranded, they've stabilized, they're crushing it, they're responsibly adulting. And that's exactly the journey we're going to experience today a bit with secondaries. Many of these episodes I've come to realize over the course of this first season on Capital Decanted are what you might call coming of age stories. And secondaries are very much in that category. In this case, we've seen secondaries morph from what I would call a niche set of transactions of distressed limited partner selling to a more than 600 billion asset management and liquidity tool utilized by the most sophisticated LPs and GPs in the world. And now very much devoid of the original stigma that plagued these activities. And we're going to talk through all of that. So here's where we're going to go to bring that transformation to life. I'm going to walk us through the actually fairly short history of private secondaries with an eye towards this maturation and metamorphosis process I just alluded to. Then I'll summarize it very briefly with an overview of where we stand today. What is the snapshot, the overview of today's secondary market? And then I'll hand to Christy for her commentary, some tips and tricks about underwriting, evaluating, and her experience on the subject. And then for our guest segment itself, well, there's always drum roll moment here, but we thought as we considered who to bring on, why not just bring in the leaders of the 2 largest secondary funds ever raised to help us crystallize and sharpen our thinking? How about that? So joining us a bit later are Vern Perry, Global Head of Blackstone Strategic Partners, or what they call BSP, which of course is Blackstone's $70 billion secondaries business across private equity, real estate, and infra. And Taylor Robinson, partner at Lexington Partners, the $75 billion secondaries manager, now part of the Franklin Templeton family of alternative managers, our signature host. So there's the map of our time together today. So Christy, before I dive into history, you authored, I'm sure you haven't forgotten this, but you authored the April issue of our Chronicles of an Allocator newsletter. For those listeners that don't view that, it's one of our actually most popular pieces of content we put out. It's Best way to describe it is a monthly newsletter where we pick a topic and have fun with it a bit and point you in different resources. So just a couple short months ago, Christy took that on as the lead author and focused on secondaries. And by the way, listeners, as is typically the case, the subject of that newsletter was both partly influenced by the fact that we knew we had this episode coming. But now that she's done the work, and of course I've benefited from reading it, it has informed our angle and thinking a bit on today's episode at the same time. So it has this reciprocity looking forward and back. It's an excellent and short read. As always with Christy, there are some great charts, some further reading, and an appropriate level of skepticism we've come to expect from our dear resident CIO. So that issue is linked in the show notes. But Christy, what was your biggest takeaway before we dive in deep from that particular research that led to the newsletter?
I think one of the most interesting things that I came away with was just the transition in this marketplace at this point, particularly that so much of the selling, I don't want to say pressure, but so much of the selling supply is now from GPs. And watching the growth of that, I think I had a chart in there where it was significantly lower leading up to 2019. And then all of a sudden it became about 50% of the market, of the actual supply out there. It was just wild to me how quickly that shifted. And I've talked to people because obviously I haven't been a practitioner for the past year or so, but I talked to a few people and it felt almost like it snuck up on everybody. It went from this whole LPs are in distress or people are selling to right size their private equity or private portfolio in some way, to all of a sudden LPs are angry. I don't want to say angry, but LPs are demanding liquidity back from certain GPs, particularly as fund life increases. And so with the advent of continuation funds, and even, I guess you could technically put NAV loans under there in some instances, there's just all of these transitions towards a more active GP selling network within the space. That was actually a little bit surprising to me, just in terms of how much that's grown recently. And then it's funny you mentioned the skepticism, because one of the biggest things that I also realized in writing that chronicles was that I have a fair amount of bias and hypocrisy when it comes to secondaries. And I will own that, I guess, on some level. And I say the hypocrisy because I totally accept public stock markets, which is a secondary market for stocks. I totally accept that as normal, and people would sell for a variety of reasons. And that doesn't mean that people shouldn't buy. And that's literally the way that this works. And I just accept it as a given because that's the water, me as a fish that I have always swam in. So it's very funny to all of a sudden realize, though, that I now look at a secondaries market developing in private markets, and immediately I'm like, why would they sell? When I could basically say the same thing in a public stock market. So I think, again, a lot of skepticism is warranted, particularly when it comes to underwriting these things. But I think that's true of everything, or of every asset that you're looking to purchase or unload. But I did recognize that there is an irony of just me completely accepting a secondary public stock market and completely, I don't want to say damning, but being very almost to the point, I don't want to say cynicism, but almost to the point of cynicism about a private secondary market. So I will own that up front and try not to let it bias my thoughts too much.
Well, listeners, the funny thing about this is Christy and I don't share our outlines or scripts with each other. We talk generally about what are you going to cover? What am I going to cover? And where are the handoffs generally going to be? But it's amazing. Once you dance for a while professionally, you start thinking alike. So we're going to jump right into the hypocrisy. That is actually where I wanted to start, was the risk of hypocrisy and how we think about secondaries. We're going to get to GP-led secondaries. You alluded to that too. And that is the very tail end of this short history, but you're right, is exploded. And it has become a very topical, somewhat controversial issue. But let's jump into the history. And as Christy just said, you have to be careful here in your logic and your thought process, because while today on Capital Decanted, our lens is going to be on secondary market developments in the illiquid arena of LP drawdown funds, you might say. The precedent, as Christy just alluded to and articulated, the model of secondaries generally are literally what's driven the financial markets for over 400 years. This is just an important reminder before we get caught up in some newness skepticism related to this growing segment. It was actually in 1602 when this began. This was interesting. When investors in the Dutch East India Company were looking for liquidity for their ownership in that global seafaring merchant trading corporation. And out of that demand for liquid markets came and arose the world's first stock exchange, the Amsterdam Bourse, today part of Euronext, which includes the Dutch, French, and Belgian exchanges today. Christy just said this. Every modern public stock exchange is, by definition, a secondary market. There's that small little carve out every once in a while, although increasingly not so much on IPOs, but the large majority of that volume is secondary by definition. And there's huge secondary markets that have arisen within commercial loans, By the way, we could do a whole episode on that colored history someday. Mortgages, think about that. Auto loans. I can assure, speaking of mortgages, that almost everyone listening, that the servicer of your mortgage today is not who underwrote the loan. Very few underwriters keep the loans on their books. And that, of course, is that secondary markets not only allow for liquidity in the system, but they also allow risk transfer and bundling and tranching of securities or loans and more flexible balance sheet management and exposures. It's both a natural evolution of any maturing asset class. And largely, I think we could say at its essence, a helpful phenomenon for most stakeholders. And so when we think about the LP-GP relationship in today's drawdown structure, the subject of today's discussion, of course, the benefits of secondaries, I think they do manifest itself, at least inherently, for all the actors. So just think about this with me. You allow existing LPs to exit early in an otherwise locked up contractual relationship if they so choose. You allow prospective GPs to get access to high quality GPs and assets instead of waiting for another fundraising round. And of course, the sponsoring GP is able to remain fully invested all the while in their portfolio companies if they're not the ones that have to provide the liquidity and the market making. So again, at its essence, I think this is a win on all sides of the transaction, but we're not going to stop there. There is nuance and rough edges to every story, and that's what we're going to try to unpack objectively here. So speaking of that story, our version, as I said, this is a fairly recent history. Our version begins in 1968, when at that time, and for actually much of the next 20 to 30 years, a private investor in a private equity fund had limited, maybe even no option if they found themselves needing liquidity. There was no secondary market to speak of. Well, enter into that stagnation, a gentleman by the name of Dayton Carr. Now, we've talked in other episodes about coaching trees or diasporas as certain asset classes or disciplines formed. You can think back to episode 7 and George Stratford in professionalizing geopolitical analysis, or episode 11 on private credit, where I think we said you could trace nearly every GP of note back to Mike Milken and Drexel in some form. So Dayton Carr's influence was not quite as ubiquitous as these two examples, but still very strong. And we're going to trace that back in a minute. So Dayton Carr was one of the very first venture capitalists in the country, standing up his business Carr Management Company that year, as I said, in 1968. And to put this in perspective, by the way, of what was going on in private capital, particularly early stage venture capital, this is less than 10 years after Fairchild Semiconductor raised what is widely understood to be the very first venture capital funding from, at the time, New York banker Arthur Rock. So Dayton was right there at the dawn of private capital. And in the late 70s, Carr Management purchased another limited partner's rights in a private equity fund, completing the first ever secondary transfer, at least what we have on record. So a few years later, in 1982, Dayton's insight begins to further develop as he sees this interest and demand rising, this idea that liquidity flexibility and market making, as it were, are needed in private funds. He forms Venture Capital Fund of America, or VCFA. And famously in 1984, Christy, as you wrote in your Chronicles issue, VCFA raises the first dedicated secondaries fund of a whopping, and this is really going to be whopping once you hear from the guests a little later about their recent funds, $6 million. $6 million fund. I should say that Dayton, in our research, I found out, passed away early in 2020. But his legacy, the machinery he cranked up over 40 years ago, has endured and only grown more prominent in recent years, as we'll talk about. Now, I made reference to Dayton's family tree, if you will. So one of the first investors or LPs in that very first fund back in 1984 was an LP called ICI Pension Fund. This was Imperial Chemicals' corporate DB plan over in England. And the catalyst for that investment was a sector lead at that plan named Jeremy Collar. Jeremy was previously head of research at Fidelity International before he joined ICI. And at the time, he was drawn to Europe's needs for a private secondary market as well. So ICI's investment in VCFA was so productive that Collar got really excited and decided to form his own secondary investment firm named Collar Capital in 1990, which went on to institutionalize much of what Dayton Carr had begun, and particularly across Europe. Similarly, Stanley Alfeld, the same year in 1990, also founded Landmark Partners, one of the largest and most reputable secondary firms out there. And by the way, you might remember in our private credit episode, was recently acquired by Ares in the middle of the pandemic. But despite that early surge of new entrants, the space, I think you could say, largely remained nascent through much of the 90s. In fact, secondary funds raised less than $4 billion between 91 and 97 as the shadows of the coming telecom and tech bubble began to lengthen. The storm clouds were forming. I'm not sure if the Asian crisis correction began accelerating the demand for secondaries, but the industry went on to raise $6 billion more between 98 and 2000, and then another $8 billion between 2000 and 2002. So the growth off small numbers is really starting to cook. But again, these are still small numbers. But the dot-com crash really pressured asset owners and investors to begin seeking liquidity. And this was perhaps, I should note, the first significant appearance, at least based upon my reading, of what we now call the denominator effect. They certainly didn't call it back then. But institutional portfolios really before this had de minimis private capital allocations. So it wouldn't even have been a thing before then, before they had material allocations to locked up illiquid capital. And for those listeners, the denominator effect is when portfolios are whipsawed way out of policy on their public equity targets due to a drawdown. So public allocations temporarily plummet, and private allocations, because of course marks are more stable, they began to look temporarily bloated. So those CIOs, and frankly, I would respectfully say short-sightedly, if they are forced to go this route, they have to pursue liquidity and rebalancing to appease their boards and their investment policy statement. And we would, of course, watch this movie in a greater and bigger arena again in the GFC and then in the COVID sell-off across the next couple of decades as private allocations were much, much higher. So around this time, 1998, Lexington, one of our guests today, and by the way, they were founded by a former founding partner of Landmark. I told you there were threads everywhere here. Lexington raises its first fund of $1.1 billion. In 2000, Credit Suisse made their acquisition famously of DLJ. And out of that combination, they subsequently formed their secondary business they called Strategic Partners, where a young analyst, Vern, happened to work. Blackstone, of course, went on to acquire the SP business from Credit Suisse in 2013. And Vern now leads that business and will join us on the show today as well. So you can start to trace the history and where they fit in this narrative, even of our guests. So prior to the dot-com crash, there's really an inflection point here. This is a fulcrum in the history where it really starts to shift up several gears. But before this, it was really a niche business, I hope you've picked up on, that was conducted by a few players. And I would describe it as more of an opportunistic capital market solutions offering for LPs that had burdened motivations to sell. So this proto stage was characterized by steep discounts on fair value, troubled assets, inefficient, limited liquidity, and I would say a mindset that was very transactional or case by case. You had to be a price taker if you needed to shed assets out of your private book at this stage, as purposes for the sale were largely not economic, but situational constraints. But as I said, it was at this moment post the dot-com crash when the modern secondary market really began to take shape. Some of this was simply the explosion of primary capital formation in private equity that secondaries were riding the coattails of. But increasingly, the evolution here was moving away. This is the metamorphosis I keep mentioning, moving away from the urgent niche selling to one of active fund management. And the 2000s saw many more entrants that created much better market efficiency and price discovery, so that actually most transactions were now occurring much closer to fair value. And therefore, they were much less an expression of distress. This proliferation of assets and actors on the marketplace, on both the buy and the sell side, had created a much more liquid and robust marketplace. So, of course, then we approach the GFC. And this temporary fire sale mentality was, again, a shot in the arm for secondary transactions for LPs looking to exit fund commitments and generate liquidity for all the reasons, denominator effect and everything else that we discussed. But again, we get back to another level of stability in 2012 because we saw a record year of secondaries at the time. So in 2012, it eclipsed $25 billion of committed capital. Asset owners were still tactically reshaping, repositioning their portfolios post-crisis. And interestingly, and this should make sense given the history, banks and insurance companies began being forced to shed some private portfolios as a result of all the new regulation and capital requirements coming out of Dodd-Frank and Basel II. So just to put some of the scale into perspective, remember we talked about that $6 million fund earlier from Dayton Carr? This is, again, in 2011, 2012. But New York City ERS, CalPERS, and State of Wisconsin all each sold nearly $1 billion books into the secondary market in that time period. So these chunks were getting very material. You needed a market to be able to absorb it. So this next final stage, 2013 to 2019, is where we're going to get to some of Christie's earlier comments, because this were the bumper years for secondaries. Primary markets were just taking off. They were skyrocketing in both fundraising and performance, and secondaries were holding on for dear life as they reached a pre-COVID peak of $85 billion in 2019, again, just before COVID. Discounts to NAV continued to shrink as demand outpaced supply, even with rapidly rising capital commitments. And according to this really great chart from Jefferies, buyout PE secondaries averaged only a moderate 5 to 8% discount to NAV over this whole period. So gone are the distress days, at least in this 5 to 6 year period. Venture secondaries, of course, are a bit higher, 20 to 30%, but both of these a far cry from those early troubled, urgent selling where you were giving up the majority of your NAV just to get these things, shed them off your books. Now, anecdotally, I should say, while these spreads pop in times of stress, as Financial Theory 101 teaches us, these spreads continue to shrink secularly, and many GPs are not accepting discounts at all. Some of this is due, of course, to the quality of the assets changing hands. It's getting better. It's getting higher quality. But the more significant takeaway here I want to highlight is that the future return streams of secondaries going forward, and this is maybe a good parking lot item for Christie to take on. But when you think about secondaries, historically, a lot of the return attribution, you might say, is that you got in at a really low cost basis. And then when things improved, you got fair value. Well, going forward with those NAV discounts being very, very muted, going forward, the return streams, the attribution are going to be much more dependent on value creation, just as in the primary space, rather than low starting prices, artificially low, distressed starting points. So just something to think about. So two other important developments I want to highlight in this post-GFC but pre-COVID period that I think are important to understand, this Goldilocks period for secondaries that was leading up to the pandemic. First, we begun to see GPs experimenting themselves with continuation funds to extend the life of holding periods, particularly for their high conviction portfolio companies or assets. And thus they allowed, at least this is their narrative to them, they allow LPs options for liquidity, meaning they can cash out, or rolling their position over to a new vehicle if they want to extend the life, extend their holding period of said asset or portfolio company. GP-led secondaries, as these have come to be known, were only 10% of all secondaries at the start of the GFC, but had risen to over a third, more than 30% by the end of the decade. And these continuation funds can often contain a small subset of what you might call trophy or favorite assets. In some cases, it's just one asset in the vehicle, which of course, by the way, is contributing to further dampening of those discounts against par because of this natural quality bias that I just mentioned. But now remember, I just said it was about a third of the total transaction volume in 2019. GP-led secondaries have come to represent half of the business today. We'll get back to this in a moment. And they become an important part of a GP's asset management liquidity toolkit as a viable alternative to the traditional PE exits of an IPO or a strategic sale. But, and this is the big but that I'm sure Christie will talk about as well, as GP-led secondaries have risen in popularity, they've also become a source of frustration and contention for some LPs. LPs have often felt hamstrung and rushed to make decisions, which obviously forces their hand, and it often short circuits their governance process, which has a deliberate, sometimes multi-meeting approval process. And often these decision trees have to be done within weeks or even days from the GP-led secondaries. So we'll be sure to talk also through this with Vern and Taylor in a little while. The other interesting evolution in this period here is the growing use of secondary funds for what I would call an on-ramp to rapidly build private equity allocations. In fact, I've mentioned it on this show a few times. I'm on a couple investment committees, and we've taken advantage of this in a few of those funds that we oversee, where we previously had no private capital exposure. So the idea here is that a pacing strategy, as most of you know, for building a new primary private equity book from scratch can take 5 or more years to execute. And due to the dynamics of capital calls and distributions, many asset owners find themselves constantly chasing, never quite grasping their policy target just because of distributions and the cash inefficiency of things going back and forth. And secondaries allow just much better capital efficiency as you can quickly build fully invested access to a diversified set of PE funds by stage, by vintage, by sector, by geography. And just as importantly, secondaries, as the argument would go, allow you to harvest 3 other important benefits. You can, what many call de-risk the portfolio, as many of the duds, you might say, have been mitigated or dissolved, meaning your risk of capital loss is lower because there's survivorship bias, if you will, in the remaining portfolio companies. Second, and relatedly, you've eliminated what many call the blind pool risk, where in a primary fund example, of course, you're committing to a GP without any transparency yet into the subsequent companies the fund will invest in. That cash is not, as we say, in the ground yet. In secondary funds, the cash flows, EBITDA, and organizational health of all the portfolio companies are, of course, knowable. They're widely understood. We know what's in there. And third, another benefit of secondaries is that it allows you acceleration up the J curve towards much closer to the distribution or cash flow stage. So you skip the negative return portion of the curve, that low end of the J, and you jump right up to the distribution portion. So as such, theoretically, and actually most data I've looked at bears this out, for all of these reasons, secondaries should, and I emphasize that, should provide tighter dispersion of return streams with less risk of losses. In fact, many studies suggest they, in fact, historically outperform primary funds as they manage some of those inherent risks more effectively. So I think this is a fascinating body of discussion and debate, because if that's the case, then you have to start debating use cases for primaries versus secondaries. These are different value propositions. Does that actually mean you can choose them for different scenarios and client environments depending on what you're looking for? I'm not completely convinced this is a different asset class than the primary PE business, but it's certainly a different doorway into the same asset class. There's no doubt this alternative door conjures up a very different risk return and time horizon structure, and it could serve as a nice complement, at least, to a primary fund structure. So again, I think we will tease that out with our guests. So finally, what does the market look today? I've already hinted at a little bit of the size, at least the split between GP and LP led secondaries, which are pretty much even, 50-50, close to that today. We left off our story just before COVID, where you might remember it peaked at $85 billion. 2023 was the third straight year of $100 billion of volume, netting $112 billion last year. And extrapolating mid-2023 numbers, which is about the best we can do, AUM now probably stands, as I opened the episode, at over $600 billion or so. But despite this strong growth, it has still not kept pace, interestingly, with commitments to primary funds, which suggests, at least logic might suggest, it still might be undercapitalized, at least versus the primary dry powder and primary commitments. And additionally, because the top 10 firms represent almost 60% of the deal flow, the power law is absolutely in full force here too. I suspect for these reasons that the environment will continue to be very healthy for fundraising and demand supply of assets and price discovery. So as I conclude, a bit of caution, or maybe at least a thought exercise that's been troubling me, Christy, as this preparation progressed and finished. Despite all these voracious tailwinds that I just outlined, private structures are inherently cumbersome. That's just a fact. They offer timing conundrums, draconian lockup rules on your capital. And as we've hopefully laid out in detail, these new solutions certainly do on paper offer a newfound dynamism for all the players involved. It solves for those natural structural limitations. But, and here's my pause, alpha resides and thrives in areas that are inefficient, that are draconian, that are cumbersome, that are limited. So if we grease these skids so much to allow for almost ungoverned, unlimited liquidity, do we actually risk an unintended consequence of stripping private capital of perhaps its greatest asset? This idea of long-term patient discipline. I've often said the most important benefit of long-term private capital is that it saves us from the worst forms of ourselves that the public markets can't. The public markets is unbridled emotion on display for the world, which creates often unnecessary and contrived volatility. So I ask, is the continued growth of secondaries and the resulting robust liquidity for any LP fund commitment at any time a good thing? Is there a tipping point at its extreme where the virtuous benefits of portfolio flexibility, more nimble asset allocation, I'm all for that, hand off to compromising the illiquidity premium or the benefit of discipline, which exists and endures only because you can be deliberate and thoughtful in your operational value creation outside that momentary machination and psychological temptations of Mr. Market that plague us often. And that's what I do. I ask annoyingly large and challenging questions and then exit stage right. So I don't have an answer to this, but with that horribly challenging rhetorical question, Christy, I segue to you and maybe ask you to first address that craziness Am I overthinking? Am I over extrapolating this potential risk?
I don't think so. Not to argue or debate semantics or anything, but let me start with on some level, I completely agree with you. But I guess I look at the illiquidity premium, quote unquote, slightly different in the sense that to me, it's not an actual premium on illiquidity itself for the sake of illiquidity. And I think you and I agree on that. But it's more like a variety of factors that are lumped together, much like factor investing that can be teased out. So when I think about it, and I think about it like factor investing, if you assume that there's no confounding variables, then you might just call it illiquidity. But in reality, it's, again, not the illiquidity itself, but it's the other factors like the control. It's the valuations, it's the pricing. And frankly, I think a lot of it, to your point, is just the opacity, the ability to get preferential terms, to get these competitive advantages, given that there's no liquidity and there's no transparency in the market space. And to your point, if those things go away, if there is increased transparency, if there is increased pricing, if there is increased ability to transact, if the ease of that side of the market, those factors become easier to execute upon, then of course your illiquidity premium goes away, period. That's just the way I look at it. Does that answer your question in a way? Because again, I agree with you at the top line, but it's funny that we still call it the illiquidity premium. It's like a weird thing that happens in my brain, I think.
I think that caveat that you opened with is really important. I want to be clear. I don't think the premium or historical outperformance, you might say, of illiquid private markets is a function of it simply being illiquid. You're right. It is that the illiquidity allows for all these other benefits. And yeah, I think that's what I was asking is that if you unwind that, even well intentionally, are you simply recreating the public markets?
I think so. And actually, it's funny because as I was crafting that response, thinking in my head, I wanted to speak to the analyst pool out there that's getting their feet wet in all of this. And just to remember that we may refer to these things as this big nebulous knot of factors. But the reality is that every single advantage or alpha calculation or whatnot is just a bunch of components of these smaller things that you can break down if you're intellectually curious enough. So I agree with you. I think that it's a great question. I think overall, just in terms of when we think about private markets, I think that sometimes people have a tendency to extrapolate historical experience forward. So I think as a lot of these factors that have historically made private assets and secondaries markets and all of these other things we've talked about throughout our entire season, we take the returns that we have seen historically and experienced and push those forward versus saying, are there huge waves of change, of true disruption almost, is the way to think about it, that might be happening in this space that maybe we should set our expectations either a little bit lower or maybe even a little bit higher. I don't know. I mean, personally, I think rates have hugely impacted privates in particular. But when I think about all of these macro factors, and then on top of that, the fund flows and the pricing and the increased transparency, which are somewhat good things, but not necessarily for returns, it's an interesting thought exercise as I think what to expect from privates going forward. So great question, all to say, and something that I think investors should be mindful of as they're looking at both this space and frankly at privates in general and broader alternative assets. So from there, I will say you touched on this, but there's just no doubt that the market for secondaries has changed in the past 15 to 20 years, not just in terms of the growth in the market and growth in the space, but also just in terms of who's transacting. And it's actually funny because when I started my career on the institutional side, again, I had spent a couple of years in finance, but then joined Cambridge in 2008. And secondaries were this incredibly quiet, hush-hush market that, as you pointed out, only happened when an LP was in distress. And even then, with the approval of a GP, because there were all sorts of legal transactional issues that had to be navigated when those assets came up for sale. But typically, again, they would come up for sale because of a need for liquidity, a need to right-size a portfolio exposure, just some need that created the, I would say, pricing opportunities for a buyer on the other end. And also, interestingly, the buyer side, the benefits were also somewhat nuanced and unique to individual LPs in the sense that you could be diversifying a new private investment portfolio. You could be purchasing good funds at a great discount. But even then, the diversification side of that in particular has always been an interesting argument because while I get it, I think it's also somewhat wrapped up in these other considerations like J-curve mitigation and frankly, IRR padding, which I personally think are terrible reasons to invest in an asset. I've learned so much on the practitioner side of how much these decisions you can make can impact the data, which I know that when you take it to investors or a board makes you feel like you're in a position of strength. But ultimately, I think that anytime you make decisions in this space on an IRR, for example, that you're not setting yourself up for success. But that's just my personal view. Feel free to call me out on Twitter and debate me on that. But I also think as these dynamics have changed, LPs in particular really need to think about how to consider underwriting funds to meet their needs. And as you pointed out, I mean, if there's not going to be the benefit of a pricing discount, you really need to understand what you're buying and why it's there. So just quick recap before we talk about the due diligence process. On a personal level, my overview when it comes to due diligence is looking at people, process, philosophy, partnership, which is a big one for me, performance and pricing. And then from there, adding on opportunity set, competitive advantage, and role in the portfolio. So when it comes to secondaries, I think that in particular, as you're kind of thinking through your process, obviously people are always going to be important because, as much as AI is taking over our business or impacting it in a way of how could it be useful, I think that people are still the number one driver here. But I think particularly for secondaries, you have to look at the opportunity set, the partnership side, the return and pricing expectations, John, as you and I have chatted about before, and then the role in the portfolio, which will be a big one. So I think where I would start then is opportunity set. So really understanding the dynamics of the market and what's impacting supply and demand in secondaries. So as you're looking to buy or you see assets out there, you're thinking about committing to a secondaries fund. I think it's important to understand what the primary and secondary drivers of both capital inflows and fundraising in the space are. I think on the seller side, you need to understand the selling pressures and dynamics and basically understanding if what seems obvious is actually a reality and does that align with the broader macro/market conditions that are expected or that we're seeing. Because if you're seeing a bunch of selling pressure, but it doesn't make a lot of sense, you have to ask yourself, are you really buying good assets? Or are you just buying stuff that should be at fire sale prices, but is benefiting from broader capital inflows in the space? So then when evaluating the return and pricing expectations, again, John, as you noted, a lot of times the due diligence process in this is so consolidated, but I think it's so important to understand what you're buying. And I mean, at the company asset level within these portfolios. So looking through the deals in each fund at the level of the fund itself. And I think that it's even important to think about this in terms of when you're committing to secondaries funds, look at what they're buying, look at the assets underneath. Does it make sense that they're buying great companies or is it more they're just hoping for price appreciation at the end? And it's so time consuming, but I think that that is probably one of the biggest steps that an LP needs to really get comfortable with before they invest in the space. I think partnership also, I put this in the third point, which makes it seem less important, but I think it's actually incredibly important. I think when you're looking at continuation funds in particular, just making sure that your terms aren't getting eroded, making sure you still have a lot of legal power to be able to kick out bad actors, to be able to work well with whoever GP you're working with. And then also if you're committing to secondaries funds, making sure that they're doing the same and not just being price takers and term takers. I think that it's a little more capital constrained relative to other parts of private markets. I think you can actually possibly drive terms in some instances. So to the ability that you can do that, I would definitely recommend making sure your terms are in order. And then I think most importantly, though, is really looking at the role that secondaries will play in your portfolio. In a world where you're not likely to benefit from severe pricing dislocations, really need to understand what you're investing in and why. So maybe even wait until there's a little distress in the space if you feel like pricing needs to be a part of your rationale, but not just saying, oh, I have this hole in my portfolio, let's put it in the bucket, but really being mindful of either is this a strategic position in the portfolio where you're going to build a long-term relationship with a secondaries fund GP or within the private market setup, that sourcing network? Or are you going to be more tactical and look at it more as like a, hey, maybe if distress happens, I would be open to this. And I think that you need to answer that question as an LP well before you're going and looking in that space. So I think the biggest considerations when looking again at the space is less being skeptical of who's buying and selling at that level. Why would you do that? But really understanding everyone's rationale for being in the space. And then on top of that, being really thoughtful of how you go through your due diligence and know that taking on anybody's, because they're not sloppy seconds, but taking on anyone's secondary assets, it's still important because we would do that in public secondary markets as well. If somebody's selling, they may be doing it for a liquidity reason or for whatever else, but you are technically buying because you want to own a piece of that company long term. And I think that you have to be thoughtful and diligent about that on the private secondary side as well. So with that, I will pause.
I think you raised so many good points. By the way, did you just coin the 4 Ps of Christy Townsend's due diligence methodology?
So technically it's 6.
6 Ps.
Well, it's the people, process, philosophy, performance, or maybe it's 5 at this point, and then partnership. But I think pricing is also a part of that on the private side, particularly for valuation. So Partnership was a big one that I pushed into my personal due diligence process during COVID. And as so much money was raised in private markets and just how some of the terms were getting so far away from LPs that if you literally price out some of the funds and set up your expectations for the outcomes of what to expect in terms of returns and risk and stuff, some of the fees and the expenses being charged against the funds made it to where you would never realize any of the actual returns that were traditionally expected. And I think that opened my eyes to, you want to pay your partners who are doing well for you, right? You want to compensate the people who are adding returns to your portfolio, but you also have to be mindful that those expenses and impacts on the fund are material. And as the owner of capital, typically for a nonprofit or for a mission-focused organization, you really do have to be mindful of who you're partnering with and making sure that they look at you as a partner and not just as an easy source of their own returns. Because again, you pay your great partners and you stick with them because you've underwritten them well. But that doesn't mean just picking a name and parking capital with them and just accepting that they're going to take 3 and 30 off or whatever the prevailing term is, depending on which part of the private space you're in.
Well, the P's, whether it's 4 or 5 or 6, it sounds like a table of contents of a book or a blog series. So food for thought there. I'll close with just double clicking on something you said, which I think was really helpful, which is the due diligence evolution of this process. So on the one hand, maybe the way I'd put it as I listened to your thoughts, on the one hand, it's not the old days of due diligence for secondaries in that was all about what price you're going to get in on. Because again, back to my point, the entire return attribution was a function of getting in low and hopefully working your way back up to NAV. Nor is it due diligence that's similar to primaries in that when you're thinking about underwriting a primary fund, it's the GPs and the GPs' history and their partnership and a lot of the other Ps that you outlined. In this case, again, without the blind pool issue, with that veil lifted, you're assessing asset composition. It's completely different. And I'm not even sure we have I guess the corollary, like you said, is maybe public markets or maybe a direct private equity investment. So it's really unique. I really love the way that you put that. It does require a rewiring, if you will, of your due diligence. So good thoughts, good reminders, lots of wisdom, particularly for LPs as they think about this coming from Christy. We are going to have to stop there. And I cannot wait to challenge and ask and learn from Vern and Taylor as we invite them into studio. But listeners, stay tuned first for Halftime, where we'll be talking to Rob Christian, the CIO of K2 Advisors. Well, welcome back to Capital Decanted and this version of Halftime. And I am here, as promised, with Rob Christian, the CIO of K2 Advisors. Rob, welcome to Capital Decanted.
Thank you, John. Happy to be here.
Well, I've been really looking forward to this. I think, as I've mentioned to you, we've been cycling through all of the sub-managers in the alternatives space and world of Franklin Templeton this season. And K2 Advisors, as I understand it, was the beginning of this journey to curate a world-class set of alternative managers. As far back as 2012 was the acquisition, and you actually were at K2 before that. So tell us a little bit about K2, its progression as you've entered the Franklin Templeton world and where you stand today.
Thank you. K2 was founded by 2 partners in 1994, and it was initially to invest their own friends and family money, which a lot of investment boutiques start that way. And then it grew. They came from an equity long short background. The hedge fund world in the early 90s was much more opaque and growing very fast. Fast forward about 10 years later, in 2010, I joined the firm. I have a global macro background. The firm had not been doing global macro, came from the equity long short world, then moved into fixed income, and then I was the last piece in global macro. And then that completed the product offering, I think, for K2. And that was 2010. And we were, as you mentioned, we were acquired in late 2012 by Franklin, but we were covering all hedge fund strategies. Our original products were traditional fund of funds, first with an equity long short focus, and then moved into more of a multi-strategy approach. Today, we still have some fund of fund products, but the industry in K2 has evolved much more than just being a hedge fund of funds, where we view ourselves more as an absolute return advisor or a hedge fund solutioning. Solutioning gets used a lot and probably too much. And that is really because when we work with clients and we have a host of products and offerings from clients, everything from some listed registered funds, both in the 40 Act world and the UCITS world, but then we also have many institutional mandates where the hedge fund program is customized for the individual client.
That's a very helpful flyover, Rob. I appreciate it. And you alluded to, as all Franklin Templeton employees seem to have in their DNA, the client as the primary reason we exist. This is a tough question when you're thinking about a collection of hedge funds, I understand. But when you counsel clients and dialogue and hold the hand of clients to think about the proper context within a portfolio of these types of offerings, how would you approach that conversation?
We are very client focused, which made the K2 Franklin combination very easy to happen. But one of the biggest questions when we work with clients is the client is like, how should I fit hedge funds into my portfolio? The next question is, where should that capital come from? Where should I be deallocating to in order to allocate to hedge funds or even alternatives in general? If you think of real estate, private credit, infrastructure, hedge funds. But that question always comes up early. Where should I allocate from? So when we initially meet with clients, we do diagnostic analytical work on their portfolios to show them where their risks are, where their potential holes are. And then clients inevitably there's probably 3 or 4 different types of clients, or wants from clients, is a better way to put it. One is they have too much equity risk and they want to reduce equity risk. Think of a pension fund or someone who has liabilities and they're pretty well matched to their liabilities and they're worried and concerned about equities. They may also have a lot of private equity or venture capital that have equity-like risk, but are not as liquid. So the first set are people that want to reduce equity risk and look for diversification in their portfolio. Other set of clients, especially this was more the case a few years ago when yields were very low, but they were using alpha generated by hedge funds as a way to replace interest income from fixed income. So thinking of alpha as a fixed income replacement, that certainly has changed today because now cash is much higher. But that's one focus. And then we've seen more and more recently is using strategies that are more oriented towards mitigating risk. So that enables portfolio investor to take more risk in the rest of their portfolio. And then we tailor custom solutions towards that.
Rob, I really like that approach because what you started with was the client has a challenge or a problem and you're solving for that. And I think so often, and I think listeners will agree with this, is that we've got a product that is trying to find a problem. So again, I think just a great echo of what we've talked about with many of your peers and Franklin Templeton's, I would say, ethos as an organization. So Rob, thank you so much for the quick conversation. Really, really enlightening to learn a bit more about K2, and listeners, stay tuned for our next segment with our guests.
Thank you.
Well, welcome back to Capital Decanted. As promised, we are now joined in studio, and we're just delighted to have them. Vern Perry, Global Head of Blackstone Strategic Partners, and Taylor Robinson, who is a partner at Lexington Partners. Gentlemen, welcome to Capital Decanted.
Thank you. Happy to be here.
Happy to be here.
Well, I think as we hinted to you guys in our preparation, Christy and I spent some time walking these listeners through the very adventurous, somewhat brief, but very adventurous history and evolution and very much coming of age story, you might say, of Secondaries. You guys have seen this from the front row seat, and we're so excited to get your perspective on some of these milestones and trail markers we walked through. But I thought I would start with Vern. And thinking through your experience at DLJ and then Credit Suisse and then ultimately Blackstone, you've sat in kind of the same seat in 3 different seats in many ways. And both of you have raised, thinking about the most recent past, some of the largest, if not the 2 largest funds in history. So I think it's great opportunity for us to take a retrospective on those last 25 years, Vern. What have you experienced in that time period? What have been those inflection points that Secondaries have taken to reach where they are today?
Thanks, John, for having me again. And I think that's a great place to start. And I'll start with this. You're right. I've had 3 different firms, 1 job. So I graduated from Harvard Business School in 2000. I've had 1 job, but it's at 3 different firms. So you do the math on that. But DLJ was founded back in 2000, so August of 2000. And Secondaries, as you rightfully pointed out earlier, was still in its infancy stage after having made its introduction in 1982, thanks to Dayton Carr. So if you go back to 2000, depending on who you speak to, that year there was roughly 1.4 billion to 2 billion of volume globally executed on the secondary market. And I would say The lack of awareness was one of the biggest regulators for getting deals done. As Taylor can attest to, we're not vulture buyers. We have a bias toward high quality. We want to buy high quality assets. We're not looking for distressed assets. But many people back in 2000 thought that's what we were and who we were. So we had to educate the market. And pretty quickly, the market started to grow because if you think about it, holders of private equity assets, by definition, hold long-term illiquid investments. So should you need to or want to exit those investments, there has to be a market to do that. And groups like Strategic Partners and Lexington Partners have helped to provide liquidity. So because awareness started to increase, more buyers started to come into the market, more sellers started to come into the market. And it was interesting, by roughly 2007, for the first time in the secondary market's history, it surpassed 10 billion of secondary volume. And that year, why did we surpass 10 billion? Well, it was probably the first year that a large public pension plan sold on the secondary market. And I would say it wasn't because of distress. It was what we call active portfolio management. They had a large portfolio, a limited size of their personnel, their team, and they said, let's reduce our holdings to reduce administrative and monitoring burdens. When that happened, lots of other large pension plans said, maybe we should sell. So there was a latent need. There were people that needed to sell but didn't know they needed to sell until someone else did it. So there was a little bit of people followed suit. So the market started to grow pretty rapidly. By 2011, the market surpassed 20 billion of volume. And in pretty short order, 3 years later, surpassed 40 billion of volume. So this market started to grow pretty rapidly. But just to go back in time, in the early days, if someone sold a portfolio, the winner took all. If they had 10 funds to sell, there was a winning bidder. They took all, the good, the bad, the ugly. They took all of them. But really by 2004, 2005, this new other thought was introduced in the secondary market, and that was the idea of the mosaic, which sellers said, I'm going to sell it to the buyer who wants it the most. I may have 10 funds. It may go to 3 different buyers, but I'm just looking to maximize price. So there started to evolve this notion that it doesn't have to be winner take all. It could be a mosaic. Around that same time, and really probably 2001, 2002, you started to have secondary advisory firms really setting a practice up in advising sellers. And some of those early groups would be UBS, Cogent out of Dallas. You had Setter Capital out of Canada. And there are other players, folks who've been doing it as long as I have will recognize those names. So you really started to have growth and evolution in this space. And what's interesting, this market really started as a secondary market for private equity interests, but quickly expanded. And by the way, venture capital interests were there at the early days, but it expanded into real estate interests and credit interests. Today, the market has evolved into having infrastructure secondary interests. That really started to take place in 2013, 2014. We now have the GP-led space, so continuation opportunities. And a lot of people will look and say, well, when did that happen? They think it happened more recently, like the last 2-3 years. That's not true. It really happened in 2010, and Taylor will probably remember this. Those were called fund restructurings, and you remember that name. And those deals were done for very different reasons. Oftentimes, GPs needed more time. They had run out of time, and they said, we really need to add value. We're trying to turn this business around. We need more time. Well, probably 5 years ago, 6 years ago, there was an influx of high quality GPs with their best assets that said, we don't need more time. We want more time. There's lots of value upside. We want to extract that value for the benefit of our LPs and our partners and our colleagues across our firm. So let's figure out a technology, a structure that enables us to hold our best assets longer. So you went from challenged GPs for the large part in the early days, challenged portfolios and assets, to really the highest quality GPs, the highest quality assets. So what I would say is if you go back over time, this market really started as private equity, LBO, and venture capital secondaries, one at a time or small portfolios, very few buyers, very shallow market, and huge lack of awareness. To today, lots of people know about, not as many as you would think. There's still people who've never sold on the secondary market, aren't familiar with what it is we do, but the awareness has increased a lot. And I would end with this. When you look at the growth of the secondary market, it has often been characterized by step function increases upward. So the growth has often been in step functions, usually in or around a disruption in the macroeconomic environment. So think after the terror attacks in the US in 2001, the downturn 2001, 2002, the global financial crisis. Initially during COVID, for a very short period of time, people who hadn't thought about selling on the secondary market, when there's some disruption, they look and say, I need to sell. And in many ways, it was reactive. But when they realized how smoothly that process was and how the benefits of potentially selling on the secondary market, they said, why don't we start doing this more proactively? And they became programmatic sellers. So they thought that they'd never do a secondary sell. They ultimately did one because of some external factor, and they started to do it on their own proactively. So that has all led to, over the last 25 years, tremendous growth. I would expect this year, 2024, we will see upwards of 140 billion of secondary volume. And if you go back 25 years, that's from 1.4 billion. So we've seen over 25 years, roughly a 100-fold increase in growth.
Thank you for that background, and especially the trip down memory lane to the restructurings back in 2010. I had totally memory hold that. But Taylor, building, I guess, on Vern's commentary regarding the stigma of these assets early on in these marketplaces, from an investor perspective, the demand and desire for secondaries has actually shifted from this idea of distressed and urgent selling to one of just a market that provides liquidity and unique advantages. So can you walk us through some of the reasons clients and LPs are interested in secondaries today?
Sure. Well, look, first, thank you for having me. Vern's and our firm have a long history of working together, and we at Lexington have a tremendous amount of respect for what Vern and team have built at Blackstone Strategic Partners. And I'd also say it's fun to hear Vern mention Dayton Carr, who was a friend and one of the reasons I explored a career in secondary many years ago. To your question, look, ultimately, investors in any asset class want the managers they've chosen to earn the returns they've said they can earn. And that's true across the entire risk spectrum of investments, from sovereign credit to venture capital. If managers perform as expected, it allows investors to allocate effectively based on their own risk tolerance and the investment time horizon for their capital. So this secondary market for private equity, the underlying assets of which are all of the alternatives, buyout, growth, venture, credit, et cetera, as Vern mentioned, because we provide liquidity to the investors in all of those strategies, we have proven it is a very consistent provider of the returns our investors expect across market cycles. Again, as Vern was saying in the intro, so I think we as an asset class score very highly on the predictability of returns scale. That consistent return, which shows tightly banded multiples of capital and IRRs, has allowed investors in this asset class to sleep easily at night. So that's the return aspect of what investors are looking for and what they like about this asset class. There are less obvious benefits to the investors in secondary funds, like immediate cash flowing portfolios. We buy diversified pools of maturing assets at discounts, and that allows our firms to pass through those distributions to our LPs to mitigate the J curve of private equity. That's fairly well known. Investors also get broad diversification by strategy, by industry, by geography, and I think importantly, by vintage. So this is the only way one can get retro exposure to earlier private equity vintages, funds raised and deals done in prior years. And that exposure is created with the benefit of hindsight. We also get to underwrite and effectively reprice assets as secondary buyers. So we're buying assets and funds whose performance we've tracked, and we are buying those at return levels of our choosing instead of investing in blind pools. So the investors, our funds, find that compelling. And one thing that I think is less discussed, the LPs in our funds do benefit from the information they see as investors with us. A typical large cap secondary fund will have exposures to many, even hundreds of high quality direct GPs and funds across sectors and geographies. And that's typically not something the LP could build for themselves without a huge team, billions of dollars, or decades of experience. So I really think these secondary funds should be the centering ballast of an LP's portfolio, around which they go choose individual managers and make direct private equity commitments that they expect to be alpha generating. It's taken our market over 30 years to get here. I think Vern points that out, and you brought that up. But I do think that finally LPs are understanding the benefits of the strategy for their portfolios and realizing that this is no longer a cottage industry. There is a big enough market opportunity to commit real dollars. And I'd also say that I suspect if many large allocators looked at their private equity portfolio returns over long time horizons, consistent commitments to secondary funds would have been accretive to their returns. So I could keep going, but for the sake of not sounding promotional, I'll stop there.
Taylor, I mentioned in the opening that Dayton had what you might call an impressive coaching tree. Landmark, Lexington, ultimately. I didn't know you had a personal relationship with them. So that's really cool and just adds to the legend that was Dayton. And I know we all were sad to see him go just a few short years ago. Vern, I want to develop this point further because I think Taylor articulated those benefits really well. And his whole use of the phrase ballast around which you build the rest of your exposure. I described in the intro how often secondaries are used as what I would call an on-ramp because of that immediate diversification. I've used it on a couple investment committees I'm on. I'm like, look, it's going to take us 5 years to build out this private equity book. Let's go in secondaries and temporarily camp out. And then we've got access. And then eventually we'll build the primary book. So I guess to Taylor's point, Vern, how do you think about secondaries if you're in an LP seat, an investor seat, as it relates to your primary exposure? Are these separate asset classes? Are they siblings? How should you think about the risk return structure and putting a portfolio together between the two?
I do think they're siblings. Obviously, they're different risk return. I couldn't agree more with Taylor's reasons for why the benefits of secondaries and why people have invested in secondary funds and what secondary funds could potentially offer. But if you look at primary funds, and I would argue, let's look at it primary fund of funds and then direct buyout funds. Let's call that primary versus a secondary fund. They're all part of a private equity strategy. And you're right. A lot of people look at it in many ways as training wheels for private equity. You're brand new. It's a good entree into an allocation. It's instant diversification, if you will, identified assets that are aged. So let's say you just started your program in 2017, for example, and you missed out on some great vintages in 2014 and 2015 and 2012, 2011. Secondary is a good way to get exposure looking back. These funds could be 4 to 8 years old in terms of the vintages. So I would argue, though, that it shouldn't be viewed as training wheels. Many of the investors and supporters of secondary funds do it, and they've been investing in private equity funds for 20, 30 plus years. They're looking at secondaries as a way to achieve a goal, to get exposure to private equity. And in their view, secondaries could potentially offer competitive private equity returns with lower risk. As Taylor mentioned, these are aged assets. They're identified. They typically, as you pointed out, John, they mitigate the J curve. They mitigate risk because they are identified. They are older. And I would argue that the riskiest point in a private equity investment's life is the first 4 years. New ownership, potentially new management, new CEO, new business plan, leverage. You're trying to expand the business and things can go wrong. If it goes wrong, you typically know within the first 24 months. But when you look at secondary funds, we're typically buying in years 5, 6, 7, 8. It could be a little older, but the sweet spot is probably years 5 through 8. By that point in time, the winners have revealed themselves. More importantly, the losers have revealed themselves. So if you're an investor in a secondary fund, what you're looking to do is mitigate risk and hopefully generate asymmetric returns where you're avoiding the losers, you're getting winners at a fair price, often a discount to NAV. So I would say you're right. Many people do look at it as a beginning point, but I think that's the wrong way to view secondaries. It's a tool. So many people in the past have said to me, why do people invest in primary funds? Why not just do all secondary funds? I think that would be a mistake as well. Primaries is absolutely part of a diversified private equity allocation. Here are a couple reasons why. You are a huge fan of a top tier, phenomenal GP. I wouldn't assume you're going to be able to buy that on the secondary market. You may not see it. Maybe someone else likes it more than you, outbid you. If you're a supporter and you have a great relationship and have had a great experience with a GP, why wait? Why not make the primary commitment? By the way, there's a potential to get significantly reduced fee co-investments as well with that relationship. But again, there's no guarantee that you'll get allocations to top tier GPs at the price point that you want. The next point is, if you're buying into that high quality GP, if you're lucky enough to in years 6 through 8, maybe you missed out on some pretty big winners in years 1 through 5, for example. So again, primaries are part of a diversified strategy. And finally, and I'm not trying to be funny here, but someone said, I think everyone should just invest in secondaries, not primaries. Well, if no one invests in primaries, who are we going to buy from? Who will Taylor and Vern Perry buy from if there are no primary commitments? So I'll end there, but I guess the key takeaway is this is just another flavor of private equity. Secondaries is a different risk return, and people find that it fits within their allocations, whether they're brand new to private equity commitments or they've been doing this for 30 plus years.
Please think of the GPs, everybody. No, I'm kidding. But in all seriousness, one of the great comments you just made was this idea of buying great assets at a good price on the secondary side as a rationale. But Taylor, again, building on that idea, can you describe the sourcing opportunities for secondaries, both in terms of buying great assets at a great price and avoiding the, I don't want to say losers, but the less desirable assets? And what's your typical process given that the motivations for the supply side of the assets available to purchase is unique? And then also the dynamics around the price discovery are also fairly unique.
First, I think Vern and I are lucky that as arguably the two largest firms in our market, I think we probably get to see nearly all of the opportunities available annually, certainly 90+%. This is also a capital constrained market. I'd say that probably less than half the deals brought to market last year traded. So when you have a large pool of capital, as we do, and we're lucky to have, and you're a household name and a blue chip brand, opportunities tend to find us on the sourcing side. So I don't want you to think that we are passive. We've spent decades building relationships with and mapping out who the holders are and the potential sellers are of these assets. So we're actively sourcing. It's just that this is not a market where unsolicited bids are well received. We have to wait for someone to make a decision to sell. I'd say at Lexington, a lot of our deals are with repeat sellers. We're really proud of that. This is a market where, as Vern well knows, information access and relationships and reliability as a counterparty and reputation really matter. So we work really hard on maintaining those. More specifically, just on process, private equity is a small ecosystem on both the GP and the LP sides. And we often hear about deals directly from the seller, whether that's an LP or a GP. I'd say it's not typical in today's market that a seller who is a fiduciary, a pension fund, an endowment, a foundation, et cetera, or as a GP on behalf of their LPs, it's typical they have to hire an advisor to run and organize sale process. So deals usually come via the seller and their agents or the underlying GPs. And sometimes that outreach to buyers like us is simultaneous. There are some proprietary deals. I've never met a private equity firm that didn't say they did some proprietary deals. But I've personally found that the intermediation in our market has created a more robust marketplace. So just in terms of the way the process works, a seller hires a bank. And as Vern pointed out, in the early days, it's the same people, just at different firms today. There are well-known specialist advisors in our market. Those bankers help curate a portfolio for sale that meets the needs of the seller. And then they approach a group of buyers that they know will have interest in that portfolio of assets. Some of the deals have broad market interest and they're competitive. Other deals, because of size or assets or geography or unique impediments to execution, like specific relationships or structures or needs of the seller, have only a handful of potential buyers. There's still a massive imbalance of supply of these deals and assets for sale versus the amount of capital available to purchase them. And I'd also say that besides capital, there are very few people or teams of people who have the expertise and experience to do the work of price discovery and then negotiate and close these deals. There are very few people who have been doing this as long as Vern has, or even I have. So our job as buyers are to look at private assets at a point in time, to underwrite and project what we believe is the terminal value for those assets in the time frame they are held by a fund, and then to decide what return we want to earn to take on that risk. Out of that analysis falls the price we're willing to pay, often a discount, as Vern pointed out. So once the price is agreed with the seller, there is then a legal transfer process that has to happen. That's a tri-party negotiation between the seller and their lawyers, the buyer and our lawyers, and the direct private equity firm and their counsel. So these are complex deals to price, to negotiate, and to close. Again, I'd say our firms are experts at moving as quickly as possible to make the sale relatively easy for the seller. But the timeline from sourcing to closing in these deals can be long, it can be iterative, and it can be winding, certainly for institutions who are new to it. So hopefully that answers the question.
I think it's outstanding. I think you also highlighted, look, the power law is alive and well in the secondaries market too. Not to put words in your mouth, but I suspect that if we went down the value chain from BSP and Lexington to a boutique, small, new entrant, that answer to that question you just answered is going to sound at least mostly different. in that they would have had to chase a lot more. It's like the old days in college basketball. How does Mike Krzyzewski get these great recruits? Well, they're knocking on his door. And that's not to take anything away from Lex and BSP. I just mean that you're benefiting, obviously, from that virtuous circle. Taylor, let me just press on that a little bit more. So you've decided to take part in this asset, this set of assets, this interest from another LP that you're assuming. And you talked about the intermediaries there. You and Vern both mentioned them. Once the transaction happens, what is Lexington's relationship with the underlying GP? Is alignment important there? What is the level of active relationship that you take part in both on the front end and throughout the remaining life of those assets?
So to be clear, we generally have relationships with these GPs and know their assets before the deal. And that relationship continues once we purchase a fund commitment or invest in the assets post-deal. But as non-control investors, I would say alignment is the thing we're always thinking about. We want to buy exposure managed by primary GPs who we know well and trust, and we need to make sure that they are highly incentivized to create value for us. There is always going to be economic alignment, but, and I don't think either of us, Vern or me, take the following for granted because it's taken years to build. The scale and reputation and investor relationships that Lexington partners and strategic partners bring to the table also provides some non-economic incentive for the underlying GPs to perform for us. So there's some non-quantifiable alignment beyond making sure a GP only makes money if we do. In a traditional partnership portfolio transaction, there isn't a huge role we play with the direct GP in the role of a replacement limited partner. We don't negotiate the fund terms. We step into another LP's capital account. In some cases, we might inherit an LPAC seat if it's a large commitment we purchase, and that gives us some influence at the fund level. The influence we have with primary GPs is more indirect. Again, they know our firms well. We share many common LPs, and ultimately this is a marketplace where we're trying to create outcomes that not only benefit our investors, but also the sellers and the primary GPs. On the GP-led side of our business, where we are creating liquidity solutions alongside primary GPs for LPs around specific assets, we do have a more active approach. So we are setting the price for an asset, we are negotiating fund terms, we are creating economic alignment structures, and often have some direct or indirect say in how and when assets are disposed. But it's always done in a way that's aligned and collaborative with the primary GP who controls the assets. Our goal as buyers is to negotiate the best deal we can for our investors. But over the long term, we need to be helpful, thoughtful capital partners, and I would bold and underline partners. This is a long game, and I candidly think that our firm and Vern's have grown to our scale by working constructively with everyone.
That's really helpful in thinking about the context. And with that in mind, Vern, I would actually love to get your thoughts on something that I've been struggling with ever since I was even on the LP side. And that's how to assess these LP versus GP-led secondaries in an objective way. Y'all will hear the beginning part that we had earlier where I joked that I realized that I had quite a bit of bias and skepticism when, for the private market, that I have none of when it comes to thinking about public secondaries, so any public market out there. But there does seem to be this lingering frustration amongst LPs when it comes to the GP-led side, particularly now that it's gone from such a small amount to a much larger amount. I think it's nearly half of all transactions at this point. So what are some of the dynamics behind this, and how should investors think about due diligence approaches between LP versus GP-led secondaries?
It's a great question. I'll start with LP-led, which is really how the secondary market really got its start. These are diversified portfolios of funds and assets sold by an LP to a secondary buyer. And it could be 10 fund portfolio, 100 underlying companies. And if you're a buyer or buyers and you're trying to assess that portfolio, you may have 2 weeks to understand or have a view on the value of those 100 underlying portfolio companies, put forth an indicative bid, and move from there. On a GP-led, it may be a multi-asset continuation vehicle or a single asset continuation vehicle where you have 2 months. So it might be a little bit longer, it tends to be more concentrated. You're a little bit closer to the GP because it's a GP-led process as opposed to LP-led. So the GP is providing information. They're running due diligence sessions. They're trying to get you up to speed to understand exactly what the underlying portfolio company has to offer, the growth prospects, potential exit opportunities, et cetera. But it's interesting when you look at the difference between the two. Oftentimes, one of the biggest differences people notice is pricing. And just to be clear, pricing is often communicated in the form of a discount or premium to NAV. So both Taylor and I have said this. It's typically a discount. It could be par or premium for LP-led deals, but typically it's a discount, but doesn't have to be. And oftentimes people read into that the higher the discount, the better the deal. We probably don't have enough time to go into that, but that's incorrect. I wouldn't read into the quality of the deal based on the size of the discount, but I would say it's typically at a discount. And when you think about GP-led deals, those tend to be closer to par. So people look and say, well, why is that? Well, I talked about it earlier. These are the all-star names. These are the higher quality or highest quality, potentially, companies being brought to market. So a diversified pool could be really high quality, medium quality, some not so great quality. But you're buying that as part of a fund. You can't say there are 10 portfolio companies in a fund. I only want 7 of them in an LP-led. You're going to get exposure to all of them on a pro rata basis. You price those accordingly. But you're curating on the GP-led side a portfolio, 1 company at a time or 3 at a time, and they tend to be really higher quality. So I would argue if you were to pull out the highest quality names in a diversified LP-led, those would probably price at par or higher. So it shouldn't come as a surprise that the GP-led tends to execute closer to NAV. But I would say the due diligence process is very differently. You can't go super deep on an LP-led process if you have 3 weeks or 2 weeks to submit a bid and you're evaluating 400 underlying portfolio companies or 100. You could go a little bit deeper on a GP-led. It tends to be more concentrated, so you should do that. Your bite size will likely be bigger, or you'll be asked to step up for a bigger bite size. And again, you have direct communication with a GP who's leading that process. So I think all of that is pretty critical. But I would go back to something you said, this frustration on the part of LPs that the continuation fund opportunity has increased in size. I mentioned earlier that total secondary market volume this year could be upwards of 140. I would suggest that it's somewhere between 130 and 140 billion globally this year. Roughly 55 to 60 billion of that will be GP-led continuation opportunities, either single or multi-asset. So the frustration to me is not necessarily warranted. I think some people look and say, there are more of these. I have to respond to the election to either roll or sell. I'm not equipped. We have a small team. You only giving me 3 weeks to a month to respond. So I get that to some extent. But I would say that over time, and this is the newest aspect of the secondary market, but I think those LPs, very smart, very capable, very sophisticated. I think many of them, if not all of them, have gotten up to speed on these processes and what it takes to appropriately respond in the period of time. But I think if you step back and just look at why these are growing, why has this segment of the secondary market grown so quickly in such a short period of time? It just goes back to a need. There's a liquidity need, or there's a solution for GPs who wanted to hold their best quality assets longer. In many instances, they've already pulled the valuation levers. They've done things that are going to create value. The value just hasn't come in yet, but it's imminent. And why should they sell it to someone else and let them take advantage of the upside? They want to hold that longer. And I would say if you were to survey every GP out there, I would argue that 95% plus would say, yes, I've sold something in the last 5 years. I wish I hadn't sold. I sold it to someone else, and within 3 years, they're sitting on 3 times their money. And wouldn't it have been great if we had held that for the benefit of our LPs? So I think this segment of the market will continue to grow. There's significant potential growth opportunities in both traditional LP-led and GP-led. But I think when you think about the GP-led side of the market and how much opportunity rests there and how undercapitalized it is, you're going to continue to see that market grow.
I think as we move to the last couple of questions here, I think you guys have really helped on the history, on some of the context and the process. Taylor, let's talk a little bit about current state. Vern in only 40 minutes has been setting the Vegas over-under at 140 billion. He's been on the record twice in such a short period of time. That would obviously be a record year, at least in my research. But you guys, just between the two of you, 45 billion in these big 2 funds of dry powder, all this has got to go into the ground. Unlike primaries, you guys have had you guys being Secondaries, have had a few really good years. And if Vern's right, it'll be another good year. So when you think of all this momentum, kinetic energy that's happening, given the need, as Vern well articulated, how are you seeing sourcing, deal flow, valuations today as we sit here in the middle of 2024?
Well, first, I'm going to start by saying I would give the same likely goalpost for this year in terms of volume. I think we do think it will be a record year. It certainly feels that way based on the volume of deal flow we're seeing. Then I would say between Lexington and Strategic Partners' latest funds, we have raised $45 billion. That sounds incredible to say. And thank you to all of our collective LPs. But we've also been deploying that capital for the last few years as we raise those funds. So the uninvested dry powder is actually meaningfully less than that headline number. Across the industry, I suspect the equity dry powder might be between $100 and $150 billion. And maybe with some assumed available financing, that equates to buying power of 150 to 200 billion, maybe at the high end. But that's roughly a year to a year and a half worth of dry powder at the current annual market transaction volumes we're talking about, which means that this is a wildly undercapitalized market versus the opportunity of assets we have to purchase. So there are tens of trillions of dollars of assets, NAV, that sit within funds where the investors would like liquidity. And again, even at $125 to $150 billion of volume, it's a little market relative to the opportunity. It's growing. It is the only place the investors can seek liquidity at a time of their choosing. And I think that's the point Vern was making. Deal flow is as robust as we've ever seen it. And I think actually that deal flow is constrained only by the limited amount of capital available to us as buyers. Remember that we secondary firms raise money from the same LPs who also need liquidity. That's the great paradox of markets like these, that the best investment environment is when the capital is hardest to find. More dry powder would likely mean we'd just see more deals. So to your question in terms of valuations and pricing, the capital constraint on the buy side allows us to be selective as buyers. And that has generally meant better pricing for us. Pricing in our market is often discussed in terms of discount, the inverse of price, as Vern described. We've generally seen higher discounts, lower prices, when there is volatility in the market and illiquidity. We have been in an illiquid and volatile market environment over the last 18 to 24 months. So it's been a nice time to buy great assets at better than historically average discounts or prices for us. Mechanically, just to get into the weeds, we quote price as of a specific transaction date, always a quarter end, like March 31st or June 30th. But those discounts are mainly a reflection of what we think the net present value of the future cash flows is. They are less a view on current valuations of those assets, which are set by the direct GPs, the firms who hold and value them. So again, I think it's important that listeners understand that we don't set the valuations of the underlying assets ourselves. That is the job of the direct GPs and their teams and accountants and auditors. We are underwriting and buying based on those valuations, which are the same as the original LPs and sellers see. So just taking a step back up, look, I think we are today buying excellent underlying companies, probably the best assets we've seen in our market history, at discounts to the stated NAVs, so below the prevailing private valuations. And I think that will set these funds, whose portfolios we're constructing today, up for great outcomes in the future.
Thank you for that. And I think as we wind down this discussion, as John said, we like to put on our philosophy hat. And Vern, I'm going to switch to you and ask you if in your view, there is a downside to too much flexibility in a private market, particularly with regard to liquidity. It's a little bit ironic, and we talked about this before, that there's benefits to the lockup capital and that it forces investors to remain invested, or it also, alternatively, on the GP-led side, forces GPs to manage and to operate effectively within a given timeline, and thus saving us from ourselves at times. So does this liquidity in the secondary market make it all too easy and make it easy to circumvent those watermarks?
It's an interesting question. It is a philosophical question. I would say one of the benefits of private equity is that it's long-term patient capital. So it's committed, it's locked up for 10-year term plus extensions. But I would say there should be flexibility. This is part of the evolution of private markets. There should be a market to provide an exit should someone want to or need to get out of a long-term illiquid asset class. For example, there could be a regulatory requirement. They have to get out. And I would put forth what's really important here is providing liquidity to an original LP doesn't disadvantage the GP. We're the substitute limited partner. Taylor said that earlier. The GP, by the way, has the right to approve us as a substitute limited partner. And part of their analysis of approving us is, do we have the wherewithal and the capital to meet future capital calls? Should they call capital? Should they need capital? They're not forced to sell assets to redeem this LP that wants liquidity out. We, the secondary buyer, are buying out that seller, and we're now in the fund as the new limited partner. Any cap calls going forward, we will meet that obligation. So as far as does this increase liquidity, is there a downside? In my opinion, there isn't. Think about it, just to use an analogy, and everyone that knows me knows I love to use analogies. Imagine you and your family are going to go on a trip. It's a road trip, no plane, just a road trip. You get on the highway. It's a 5-hour drive wherever you're going. No exits. You need to get something to eat, no exit. You have to use a restroom, no exit. Or you decide you don't want to go there anymore. You need to get off. There's no exit. There has to be allowances. I know that's just a road trip, and I'm using a highway as an analog for private equity markets. But there are lots of legitimate reasons that people need to exit. And I would actually say because of that flexibility, there's more upside to the overall ecosystem. An investor is more likely to make a primary commitment if they know if they have to get out, they can. And I think that has actually grown the pie. If you look at the last downturn, 2009, let's just go back to 2009 to today. The amount of dry powder or private dollars committed to private equity funds has increased fourfold. The number of active institutional investors committing to private equity funds since 2009 has increased sixfold. I would argue that a big reason why those numbers have increased so much because there is a sophisticated secondaries market to provide liquidity should they have to or need to get out. So I think there's actually more upside to having this flexibility in terms of liquidity than downside.
I totally agree.
Taylor, anything to add to that as we close on the philosophical side? Is there a inflection point where we are, let me just be controversial for a fact, where we are recreating the worst of public markets in the private markets if we go too liquid?
I'm happy to start with that. I think the important distinction, and Vern made it, is that even though we are providing liquidity to the ultimate investors in these assets, the assets themselves are not being forced into sale at the wrong time. So what we are providing is the ability to recycle the investor base in these assets while they are still controlled by the people who know them best. And they are exited at the time that makes sense for that asset. And I think it makes for a healthy ecosystem for private equity, as Vern pointed out. And it doesn't force what happens in other asset classes when the investor capital can flee at the worst times, which is forced asset sales when markets are down and illiquid. And I think that is the important distinction. I think it's what makes private equity the best performing asset class in most portfolios over multiple time horizons. And I 100% agree with Vern. And we say it ourselves. We think a healthy secondary market makes a healthier primary market for private equity. So nothing controversial to add. I'm just agreeing with everything that's been said.
Here, I'll share a data point for you. Depending on who you speak to, there's about 13 trillion of value in private market funds today. 1% of that trades on the secondary market. 1%. So I would say we're not even remotely close to a problematic liquidity issue in the secondary market. And over the near term, medium term, and long term, there's tremendous increases in liquidity, I would argue. I think that 1%, we call it the turnover rate. Could it be 3, 5% in the next 10 years? It could be. Don't know. Unclear. But there's no doubt about it, that percentage will grow over time. But it's not as liquid as you might expect. But when I provide those numbers, I think it lays bare that this market is not overly liquid, if you will.
That's very helpful perspective. And even if there is a number, which I tried to bait you into, and neither of you bit, but even if there was a number, it's way above 1 or 3 or 5%. I think we can certainly all agree to that. So Vern, Taylor, I think we should probably leave it there. That was a great articulation, and ending with some philosophical debate is always a good thing. So gentlemen, it's been a real pleasure. You have filled gaps, you've corrected some assumptions, and I think enlightened all of us. So really thankful for your time. And listeners, stay tuned for The Last Sip. Welcome back to The Last Sip. What a great conversation. I actually learned a lot. And I don't say that because I'm shocked that I could learn from them, but just given all the history, often these are more validating, clarifying than they are new information, Christy. But I felt like Vern and Taylor did an outstanding job of actually correcting and enlightening me. And us were the words I ended our discussion with them with. So how about you? What did you learn? What was a big takeaway or two of your experience through this episode?
Well, I think both of them touched on this, and you and I have talked about it throughout the season, that in whatever market or segment or industry you are in on the private side, that the people and the relationships and the values alignment is always going to be important, even when you're haggling over pricing and terms. So I think that that was a nice confirmation bias, if you will, but also a truism that I've learned after 17 years in this industry. So I enjoyed that. And then also just recognizing that as much as it's grown, it is still a pretty niche space in terms of at least the funding and the ability to grow. So I think that this industry, particularly on the institutional side, when you're working with billions and trillions a lot, it completely skews your view of how big a marketplace is. So while we may see 150 billion or whatnot in flow, it's still such a small amount relative to the broader private markets. So those were my thoughts that are now pinging around in my head. What about you?
I think that last point is such an important one. I think Vern's final answer on the 1%, I think was so helpful. To your point, to put in perspective, we throw around these dollars and big numbers all the time, forgetting sometimes the relative relationships between them because they're all big and hard to comprehend often. But as I said, in response to that is that this is tiny in comparison. Thinking of liquidity too, which is really the context of that question, I think it was really interesting the way they responded to our question around risks of too much liquidity and short-termism that could creep in that the underlying GP is not changing. I think that was a really good clarification they made, is that the players that are focused on operational improvement over the long term are not changing. So there's this liquidity around it, but that's a critical, I think, nuance to understand. It's not that they're starting over. It's not that this is fresh ownership underlying it, but it's not a change in day-to-day structure and management and oversight and improvement. That was, I think, really interesting. The one raised my eyebrow a little bit moment was this idea that when they were talking about the underlying GP, basically approving them as an acting LP, just is a really interesting way to put it, in that as you start to think about that, so you've got a GP acting as an LP, even though it's not their money. And I know they take their fiduciary responsibility seriously, but they're not used to being an LP. They're getting more used to it, but this capacity they have to act in, the hat they have to wear on the LPAC, which sometimes apparently they get access to, is just an interesting dynamic. They're not used to that. And how well do they act in those roles? And if you take that to an extreme, if a GP's LPAC consists of all GPs acting as LPs, that's an interesting bunch of questions that I would have as well. So that was more just a dilemma and a thought exercise I was thinking through as he said that.
More common than one would think. Quite a few consultants that sit on LPACs as well.
I still see that as a little bit different, but I hear you. I hear you. To your point, this is becoming, by definition, more common. It was not the case 15 years ago, but there are many acting forms, acting flavors, as you just described, of LPs. So quite interesting. Well, I hope all of you listeners found that as interesting too. And I'm sure you had different or slightly altered takeaways and revelations. So anyway, we will leave that part there. As we close this season, Christy, we're off to break. We're off to summer break. We're off to final stages of pregnancy. Congratulations in advance. I certainly will be talking to you, but I just want to say that publicly. I wish you the best. I certainly hope for all three of you, and then soon to be four of you, that goes well. But as you reflect back, as we close off and tie the bow on this very exciting first endeavor and journey we've taken together of season one, what surprised you? What was a highlight? What was maybe an expectation that you didn't know coming in that hits you from behind? I'd love to hear, and I'm sure the listeners would be interested in hearing what you learned along the way.
I think some of the highlights were, first and foremost, just right out of the gate, we got really great guests this season, just really amazing thought leaders in spaces. And I was just really thrilled and humbled to be able to share a platform with many of them. And then watching their continued success and as they branch out, I know one of the ones I wanted to mention is, for example, Sarah Samuels had her book, Braving Our Savings, come out. So it's available on Amazon. I actually bought a copy for my daughter. She was super excited about it. Came in yesterday. So as I think about the caliber of people we've been able to bring to our broader listenership, I'm really honored to be a part of that. And beyond that, it's been fun. It's been hard work. I know, John, you and I have talked about that. We spend a lot of hours prepping for these episodes, but learning a lot, sharing a lot, just having the opportunity to be prepared and to get to talk about the interesting aspects of our industry in a space like this has been really neat. And I think for me specifically on a personal level, it's been fun because I think so often when I would sit across from GPs or larger strategic partners and investors, I would have an adversarial fiduciary hat on. And I even noticed that I would sometimes be a little biased and would discount things that people say. But as I listen and as I've been able to take that hat off and really listen to people, I think it's actually made me a better and more thoughtful investor as I think through what actually creates a good opportunity. What are my biases as I think about these spaces, particularly the more controversial ones? So I've learned a lot about myself as an investor, which is a big surprise because I feel, again, when you've been doing it for 15 to 20 years, it's exciting to realize something new about yourself in that way. So what about you?
Yeah, the guests were just amazing. I think we owe particular thanks to Scott Cooper and Andrea all the way back in episode 1. They more than anybody else took a chance with us. And as you'll see at the end of the season, I don't know if it'll be number 1 or number 2. There is as I alluded to in the intro, a horse race going on for that top spot, but private market valuations is still the top or the second. It was an outstanding episode and it was our very first one. I think you and I have gotten better at this, so they had to struggle with our maiden voyage at the time. I think back to the moment where Chris Ailman and Ashmi Monk were bantering and calling each other Yoda and Jedi Knights. I mean, hilarious. The wine episode was my labor of love, as you could tell. I was just giddy through that entire episode. I'm thankful for Jen Choi in the episode on private market valuation for providing a little bit of that therapy, as I called it at the time, about where we are in the professionalism trajectory of this whole industry that we love and serve well. And I think she was really helpful in providing proper perspective on the generational path and journey that we're on. And obviously TPA, that episode, all of these episodes, it's like choosing your children. They're all amazing. TPA, to be able to tell that story that was very personal for me and take a lot of pride in that thought leadership piece that we dropped and be able to draw the corollary through this verbal medium of how it all occurred that you can't really do with the pen was a lot of fun and cool. So there's just so many highlights to me. And I'd echo what you said. On the other hand, man, is this hard. Man, is this hard. It is a lot of work and you learn a ton. There's so much benefit. It helps me in the rest of my job. I love meeting these people so much smarter than me and to be able to be associated and have that lead to other opportunities to sit with them on stages, real life stages, not studio stages, to build firm and enterprise relationships with them through our Kaya hats. So it's just been such an amazing journey. And I am excited about a break, but I am very excited about next season as well.
Absolutely.
So friends, listeners, thank you most of all. There's no reason to do this if Christy and I are just talking to each other and dragging Susie and Paulina, our very capable production team, along. That would not be worthwhile for all of this work. So you make it possible. As I mentioned earlier, the little encouragements and affirmations and congrats along the way through social and in person, they mean the world to us. It has kept us in the game, if you will. It has kept us continuing to work hard on your behalf. So thank all of you for just hanging in there and being loyal listeners, and I hope we do well by you and improve even more next year. And I'll reiterate what I said at the beginning. We want your feedback. So send us LinkedIn messages, send us emails. We want this to be your show, not just our show. So with that, thank you again. Have a lovely summer or winter for our friends in Australia and New Zealand and maybe the South Africans. But otherwise, have a good few months and we're going to get off with a bang in season 2. So we'll see you then.
We'll see you then.